Hey everyone, welcome back to Corporate Decoder, the place where we break down corporate jargon and financial filings. Today we're diving into VeriSign Incorporated's latest quarterly report to see if they're still the undisputed king of domain names, or if new competition is starting to rain on their parade. Alright, let's get straight to it, starting with how VeriSign capped off its third quarter. When we look at VeriSign's financial statements, the first thing that jumps out is their revenue. For the 3 months ending in September 2025, they pulled in $419.1 million. That is a solid 7% jump from the same time last year. For the first 9 months of the year, revenues hit $1.23 billion, up 6% compared to 2024. This tells us that despite the ever-changing internet landscape, the com and net domains are still very much in demand. What is even better for VeriSign is that their operating income, which is basically the profit they make from their core business operations, is also climbing. In this quarter, it was $284.3 million, a 6% increase year over year. Over the 9 months, operating income reached $836.2 million, up 5%. This shows they are efficiently managing their costs while growing their top-line revenue. Now let's talk about the engine driving these numbers, domain name registrations. As of the 30th of September 2025, VeriSign managed a staggering 171.9 million com. And net domain names, that is a 1% increase from a year ago, and a 1.4 million net increase from just 3 months prior. This steady growth in their domain base is a strong indicator of their market position. They also processed 10.6 million new com and net domain name registrations in the third quarter alone. This means new businesses and individuals are still signing up for domain names, which is crucial for VeriSign's long-term health. Perhaps one of the most important metrics for VeriSign is their renewal rate. For the second quarter of 2025, their renewal rate for com and net domains was a healthy 75.5%. This is up from 72.7% in the same quarter last year. A high renewal rate means customers are sticking with VeriSign services, which translates into predictable and recurring revenue. This is the kind of stability investors love to see. From a cash perspective, VeriSign is in great shape. They generated $801.5 million from their operations in the first 9 months of 2025, a significant increase from $671.1 million in the same period of 2024. This shows they are effectively converting their profits into actual cash, which gives them a lot of flexibility. What are they doing with all that cash? Well, they are returning some to shareholders and buying back their own stock. In the third quarter of 2025, they repurchased 0.8 million shares for a cool $215 million. They also have a massive $1.33 billion remaining under their share repurchase program, suggesting they are confident about their future and believe their stock is a good investment. And for the shareholders, they've started a quarterly dividend. In October 2025, they declared a dividend of $0.77 per share. This means VeriSign is not only growing but also committed to sharing its success with its investors. Digging into the details, we see VeriSign's assets are primarily made up of cash, marketable securities, and some long-term assets. On the liability side, they have deferred revenues, which is money received upfront for services to be delivered later, and a significant amount of long-term senior notes. This shows they are using debt to finance their operations and growth, which is common for large companies. Their stockholders' equity shows a deficit, meaning their liabilities are greater than their assets. This is common for mature companies with significant accumulated earnings and deficits, especially when they have been actively repurchasing shares and paying dividends. The accumulated deficit is large but shrinking relatively, signaling that their profitability is outstripping their historical losses. Looking at the income statement, the cost of revenues, which includes things like salaries, depreciation, and fees to ICANN, increased slightly. Research and development expenses also saw a modest increase, which is good to see a company investing in its future products and services. Selling, general, and administrative expenses went up by 18% year over year. While growth is good, a faster rise in these operating expenses compared to revenue growth warrants attention. On the flip side, interest income from their investments has decreased. This is mainly due to lower amounts invested in debt securities and slightly lower interest rates. This is a small point, but it indicates they might be deploying more cash back into the business or returning it to shareholders rather than holding large investment portfolios. Their income tax expense remained relatively stable, with an effective tax rate of 22%. They mentioned a new tax law, the One Big Beautiful Bill Act, enacted in July 2025, but it did not materially impact their tax rate. Now, let's talk about liquidity. The company has a substantial amount of cash and marketable securities, totaling over $617 million as of September 2025. This, combined with their operating cash flow and available credit, suggests they have more than enough resources to cover their short. term obligations and fund their ongoing dividend payments and share buybacks for the foreseeable future. Digging deeper into revenue drivers, VeriSign explicitly states that price increases for com and net domains, along with the growth in their domain name base, are the main reasons for revenue growth. They also mention a recent renewal of their com registry agreement with ICANN, ensuring they remain the sole operator through late 2030, with provisions allowing for price increases. This is a significant strategic win, securing their core business for years to come. Geographically, the US continues to be their largest market, bringing in the majority of their revenue and showing solid growth. Europe, the Middle East and Africa, or MEA, also showed strong growth at 13% for the quarter. Asia Pacific and other regions also saw increases, indicating a balanced global performance. However, it is not all sunshine and rainbows. While revenue is up, selling, general, and administrative expenses saw a notable jump of 18% in the quarter. They attribute this to higher compensation, benefits, and legal expenses. The increase in legal expenses is something to keep an eye on for any company. In terms of risks, VeriSign points to factors like changes in internet practices, consumer behavior, and global economic conditions as potential disruptors. They also highlight competition from other top-level domains and alternative online presence services like social media and artificial intelligence. While these are valid concerns, their strong market position and the fundamental need for domain names suggest these risks might be manageable for now. Looking at other important information, VeriSign has made some procedural changes. The board approved amendments to their bylaws that designate specific courts in Delaware and federal districts of the US as the exclusive forums for certain legal disputes. This is a move to streamline and control potential litigation. So, what is the verdict on VeriSign Incorporated based on this quarterly report? They are still a dominant force. Their core domain name business is growing, their financial performance is solid, and they are effectively managing their cash flow, even initiating dividends and share buybacks. The renewal of their com agreement is a huge positive, cementing their market leadership for the next 6 years. However, the rising selling, general, and administrative expenses, particularly legal costs, are worth monitoring. Companies like VeriSign operate in a dynamic digital space, and while domain names are fundamental, they need to stay ahead of evolving internet trends and competitive pressures. The increasing use of AI could potentially shift how people interact online, and while their filings don't suggest an immediate threat, it is an area to watch. But overall, VeriSign appears to be a well-run company with a stable, recurring revenue model that is still growing. They are navigating the landscape effectively, returning value to shareholders, and securing their future. What is your take on VeriSign's latest financial report? Do you think their dominance in the domain name market will continue, or are there other emerging threats we should be aware of? Drop your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth looks at corporate filings. And don't forget to join our Discord community linked in the description for even more discussions and insights. Thanks for watching, and we'll see you in the next one.